as we head toward the close, we do want to bring in BTIG's Jonathan Krinsky. Jonathan, thank you so much for joining us here today. Obviously, we've had a lot of discussion about how AI is driving things lower today. You're looking at the 50-day moving average. What's so important about what you're seeing right now?
Hey, Courtney. So, yeah, it's been a remarkable streak. We have not touched the 50-day moving average in 145 trading days. That's the third longest streak since 1990. The second longest streak ended in 2007 at 147 days. So we're quickly, coming up on the second longest streak in the modern era. And so that's the backdrop. Now, there's kind of two competing forces here. On the one hand, trend and momentum of the index of the S&P and the NASDAQ are quite strong. And we're in a seasonally bullish period when the market's in an uptrend. November, December tend to be even that much stronger. The issue is that under the surface, as many are aware, the internals are anything but robust. Last week, for instance, we had 9% of the S&P hit a 52-week low. And, the issue, you can have a market when there are a number of stocks underperforming on a relative basis, but when you start seeing absolute price weakness to the extent where, they hit a 52-week low, and let's be clear, 25% of the market is within 10% of a 52-week low. So there's really this bifurcation going on. And so that setup leads us to, at least at a very minimum, test the 50-day moving average. But we think more likely you actually see something closer to 6,500 in the S&P before you see more fully washed out conditions.
Okay, what about the put call ratio? I know you watch this one too.
Yeah, I mean, so look, the other issue, aside from breadth being much weaker than the index would have you to believe, is sentiment is quite complacent. So put call ratios are a good transactional indicator. You have survey data where you ask people, are you bullish and bearish? But the put call ratios are really, what are they actually doing? And they're bumping along year-to-date lows on a 5 and 20-day basis, meaning there's very little interest in hedging. And that's another concern. You can also see it in something like the National Association of Active Investment Managers. Their exposure last week hit 100, which was the highest since July of last year. So there's just a lot of indications that people are, certainly, if not euphoric or optimistic, at least complacent, and that's another market risk.
I really am always interested in consumer and market psychology. And Bitcoin has sort of been hovering around this $100,000 mark, which is a psychological level for people that watch this. What does it tell you when you look at it on the technicals?
Yeah, I mean, so two things. From a purely price standpoint, 110,000 was kind of our initial support, and that certainly broke. Obviously, 100,000, as you mentioned, is psychological. That is a level that people will be watching. But, the reality is it just doesn't act well, given what gold's been doing, given what the NASDAQ's been doing. And if you look over the last couple of years, there's a very tight correlation, or there has been, between Bitcoin and the NASDAQ. And, all correlations do break eventually. But I think, the relative weakness of Bitcoin was another red flag for us when coming into November, looking at the NASDAQ.
And then very quickly, before you go, I want to dig into gold just a little bit more. It is down just a touch here today, but what a run gold has been on. Can you sort of tie it all together for us between what you're seeing with markets, Bitcoin, gold, and all those technicals? What does it mean? Is it really breaking from how we've typically watched gold trade?
I think you can get, you can look at a lot of different ways to ask what gold means, but as far as what is the chart telling us? I mean, look, it got about 30% above its 200-day a few weeks ago. That's about the widest spread it's been in the last 20 years. So some consolidation was needed. It's had a little bit of it, but on a monthly basis, it's still very extended. So we think probably setting up for another leg lower, also likely testing its 50-day, as many other markets are as well.
And gold's still up about 51% year to date. Jonathan Krinsky, thank you very much for joining us from BTIG.